Good afternoon, Chairman Frank, Chairwoman Velasquez, Ranking Member Bacchus, Ranking Member Graves, and distinguished members of the committees. Thank you for the opportunity to testify today on behalf of the Office of Thrift Supervision. I think we all recognize that banks and thrifts remain under tremendous stress due to continued declines in home prices, high unemployment rates, pressures on commercial real estate, and the improving but still hobbled secondary market for mortgages. We need look no further than the high levels of delinquent loans and home foreclosures and the increasing number of financial institutions that are troubled or failing under the strain. As a counterweight to this stress, financial institutions are building capital levels and loan loss reserves, thereby making fewer dollars available to lend to consumers and businesses. No one wants to return to the days before the recession when too many loans were made using underwriting criteria based not on the borrower's ability to repay, but on the value of the collateral, value that we now know was fleeting. But we also recognize that the economy will not recover fully until financial institutions resume lending at levels that can help sustain a thriving economy. Many sources of credit before the recession, such as highly leveraged and underregulated non-bank businesses that often maintained loose underwriting standards, have gone out of business. Their departure from the marketplace leaves borrowers more dependent than ever on regulated banks and thrifts, and as a result, lending by these institutions is more essential. The question before us today is whether banks and thrifts are tightening credit to an unreasonable level beyond what is prudent for safety and soundness, and what regulators can do to ensure that the financial institutions they regulate strike the right balance between lending and safety and soundness. I have seen some executives at banking institutions quoted as saying that they want to lend more, but that their regulators won't let them. In some cases, that is certainly true. An institution with soaring levels of bad loans and insufficient capital faces the all too real prospect of failure if capital and loan loss reserves do not increase. And to state the obvious, a closed institution doesn't make any more loans. The regulator might be painted as the culprit in restricting lending, but on the other hand, the regulator might also succeed in helping the institution return to a healthy condition so it can resume meeting the financial services needs of families and businesses in its community. For healthy institutions, let me make clear that the OTS is encouraging all types of loans allowed under the Thrift Charter, as long as thrifts follow prudent underwriting standards to ensure each borrower's ability to repay. The OTS and other regulators have made this position very clear to regulated institutions twice in recent guidance, and at the OTS, we have taken several steps outlined in my written testimony to make sure our regional offices and examiners in the field are in lockstep with Washington on this issue. I also note in my written testimony that small business lending is fully consistent with the mission of the thrift industry to serve America's consumers and communities. However, thrifts are limited by law in the amount of small business lending they can do. This restriction makes less credit available to small businesses, and although the House Financial Services Committee has voted 3 times to remove the cap on small business lending, and the full House has passed it twice, this provision has never been enacted into law. Thank you again for having me here today, and I'm happy to answer your questions.
We have an hour and 35 minutes with this panel, and I am going to forego my own questions in the interest of accommodating all the members. And we are next on the Financial Services Committee to Mr. Foster of Illinois.
Well, thank you all for appearing today. I'd start out by saying that I'm a big fan of loan incentives for viable businesses in the existing conditions. I think that's something we just have to do. And I concur with Administrator Mills' conclusion that we must work with existing institutions, that there simply is no time to bootstrap a new direct loan program because of the staff the staff issues. And so my first question is, do you think that the programs that are being talked about are dealing adequately with a moral hazard, that particularly when you start getting into issues of like refinancing, that they're, the 5 program and so on, that banks may have an incentive to push off their problem loans onto SBA refinancing? And do you think that that moral hazard is being adequately addressed?
Thank you for your question. We've proposed a series of activities that are built on what has been successful so far. So in the past year, we raised our loan guarantees to 90%. And we took very seriously this issue: would we experience this moral hazard that you described? Instead, we have found that, number one, there is great demand because banks want to make good loans, but for various reasons can't take those risks. And as their credit box moved up, ours moved up under them. And in fact, the credit scores on the loans that we did, this $20 billion over this last year, are actually higher than the credit scores from 2007, 2008. In the case of the 504 proposal, we are looking at refinancing owner-occupied real estate, not commercial real estate that's been speculative, but a dentist who owns his dentist office, a manufacturer who might own the warehouse, and that those loans be in good standing. We know there are a significant amount of them that were done in 2005, 2006, 2007 with 5-year bullet refinancing provisions that will come due 2010, 11, and 12. And this proposal is constructed to meet the needs of those who have been owner-occupied and not been in default, but for various reasons their banks won't be able to take on the refinancing.
Okay, thank you. Do any of the other panel have comments on the moral hazard problem? Okay. I guess then the second general question I had is the right sizing of these. It's obvious that in an efficiently designed program, the larger the program, the deeper you're going to have to reach into less credit-worthy borrowers. And at some point that will increase the risk of the government running these programs at a loss. But however, strictly from the point of view of the greedy taxpayer that wants to minimize the national debt when all this plays out, it may make sense for the government to operate these at a loss, particularly because in the case of refinancing, for example, the hole in the economy that exists when a company fails puts people onto unemployment, onto food stamps, and so on and so forth. So that when you do the overall optimization, it may make sense for the government to run these at a modest loss. And has anyone done that sort of analysis to determine the optimal size of these programs?
Perhaps I could respond to your question, Congressman. From the standpoint of the Treasury and our advocacy of the Small Business Lending Fund, we've sized that program at $30 billion. If you look at the total amount of small and mid-sized bank lending on their books today, it's about $550 billion. If this program were funded by Congress, we could increase lending, we think, by at least 10%. We think that's a reasonable amount. It's prudent. We think the cost of this program, let me stress, this would be an investment in banks. We expect to get almost all of that money back. The cost to the taxpayer, we think, will be quite low. Right.
Well, in which case, it's too small. By the line of logic that I just went through.
Let me say, though, that we'd be we'd be investing in viable banks, deemed by the regulators to be viable, and that's the vast majority of these banks today. We already have experience with investing in banks. We've invested through the TARP in 700 banks, and to date, the taxpayer has obtained a profit, even though that was a very large amount.
Yeah. Would it be possible for you to get back with us with some sort of estimate of, the other part of that equation that I went through? It would be very valuable in understanding what the rights. And I guess the third point I'd like to raise.
It won't be much time. Your time expired.
Sorry.